Welcome to the deep dive. When you look at the financial markets today, it can feel, well, overwhelming, right?
Definitely. It's this high-tech, high-risk maze.
Yeah. Algorithms, flying robots, trading faster than we can blink. It feels like a game rigged against the average person.
And, that feeling, it's not really an accident. A lot of the traditional system is built to be confusing.
Opaque.
Yeah, opaque.
Yeah.
It pushes you to hand control over to so-called professionals.
Who then charge pretty significant fees, keeping you on the outside looking in.
Exactly. So our mission today is really to cut through all that noise. We want to give you the blueprint the real insiders use.
Okay, so we've basically distilled insights from, 50 interviews?
50 of the world's top financial minds. Self-made billionaires, Nobel winners, the titans of finance.
And the goal is a practical blueprint, right? 7 steps for financial freedom.
A blueprint designed to work, survive and thrive, no matter what the market's doing, any conditions.
And we're focusing only on people with proven track records, decades of success, not just talk.
Absolutely. Because the core idea here, if you boil it down, is that success leaves clues. It's not luck.
It's about mastering the mechanics and the psychology.
Both. You need the system, but you also need the mindset. This is about replacing the hype with time-tested principles that actually work, principles that weather the storms.
All right, so where does this journey start? Not with a stock tip, I guess.
No, definitely not. It starts with something much more fundamental. A commitment, really.
Which is?
Deciding what slice of your income you get to keep, your freedom fund, before anything else gets spent.
Pay yourself first, that old chestnut.
It sounds incredibly simple, maybe even basic, but that act of separating earning from keeping, that's the watershed moment.
It shifts you from just earning a wage to actually building wealth.
Precisely. Whether it's 10%, 15%, whatever you commit to, doing it first every single time you get paid. That's the engine.
And that commitment unlocks, the magic of compounding, right?
Right. The almost unbelievable power of compounding. Yes. Time is the key ingredient.
We've seen so many stories where starting early was way more important than the amount invested.
Oh, completely. Burton Malkiel, the economist, he did this great thought experiment. 2 brothers.
Okay.
One starts investing young, say age 20, just small amounts consistently. The other brother waits maybe till 30, but invests a lot more each year.
So the late starter is putting in more total cash.
Way more total cash.
Yeah.
But the brother who started earlier, because of that extra decade of compounding, he ends up with something like 600% more money at retirement.
Wow, 600% more just from starting earlier.
Time is the amplifier. It's just mathematical leverage.
And we see this in real life too. Theodore Johnson at UPS.
Great example. He wasn't a top executive, worked in personnel, comfortable, but not rich.
But he got the Freedom Fund idea early?
Yes. And he just consistently reinvested dividends, let the stock splits happen over decades. That modest investment, it grew to over $70 million by the time he was 90.
70 million. Yeah. Incredible.
Or think about Ozila McCarty.
The woman who did laundry.
Yes, in Mississippi. Earned a very humble living. No fancy brokers, no complex investments.
It's a simple saving.
Penny wisdom, they called it. She just saved diligently, put it in simple accounts, let compounding do its thing for decades and decades.
And then she donated a huge amount.
At 87, she gave $150,000 to the local university for scholarships. It shows the consistency and time. They work for everyone, not just Wall Street types.
Okay, so if the mechanics are simple, start early, commit a percentage, why do so many people, not get there? Why do they fail?
That's the multi-million-dollar question, isn't it? Why do we get in our own way?
Yeah.
And the consensus from these financial giants is really stark. 80% of success is psychology. Only 20% is the mechanics, the how-to.
80% psychology. So failure isn't usually about the strategy being wrong.
Almost never. It's about a limiting story. That internal narrative we have about money or ourselves.
Things like, I don't earn enough, or this is just too complicated for me.
Exactly. Or the big one. The whole system's rigged anyway, so why even try?
And those stories, they just stop you cold.
They create this psychological wall. You can have the world's best plan, but if your story says, I can't, then you won't. Real change, lasting change, only happens when you consciously decide, okay, that old story's done, time for a new one.
And this isn't just motivational fluff. The story we tell ourselves actually impacts us physically, right?
It does. Look at that Stanford study on stress. It's fascinating.
Tell me about it.
They tracked thousands of people, looked at their stress levels, but crucially, also asked them if they believed stress was bad for them.
Okay.
The people with high stress, who also believed stress was harmful. They had a 43% higher risk of dying. 43%.
Whoa, but what about the high-stress people who didn't think stress was harmful?
That's the amazing part. The people with the same high level of stress, but who saw it as, their body getting ready for a challenge, a motivator, they were fine. No increased risk.
So the belief about the stress changed the physical outcome.
Literally. Your belief changes your body's reaction.
Yeah.
So if you believe the financial system is rigged and you're doomed to fail, your mind and body will conspire to make that true through inaction. Change the story, change the outcome.
Okay, so mindset first, then what? The blueprint moves into becoming an insider, learning the hidden rules.
Exactly. Step 2 is pulling back the curtain on the traps. The myths the industry uses to, frankly, siphon off your wealth. We need to talk about myth number 2, the fee trap.
Ah, fees, the small price to pay for expertise.
Yeah, right, that's the line. But it's the silent killer of returns. You see that expense ratio on the fund document, maybe 0.75%, 1%?
No.
Deliberately small sounding. It's like the sticker price on a car showing only the cost of the engine, maybe.
It's misdirection. What's hidden underneath?
Oh, a lot. You can have over 10 potential layers of fees baked in there. 12 B1 fees, that's marketing costs passed to you. Trading costs inside the fund, which can be huge. Soft dollar costs, custodial fees, admin stuff. It adds up fast.
So that 1% advertised could actually be, what, 2%, 3%?
Easily. And the impact over time. It's devastating. Studies show the average actively managed fund, with all its hidden costs, can eat up something like 60% of your potential returns over 30 years.
60%? That can't be right. How does that even work?
Compounding. Fees compound just like returns do, but they work against you. Let's make it concrete. 3 investors, Jason, Matthew, Taylor.
Okay.
All start with $100 K. All get the same 7% gross return for 30 years. But Jason pays 3% total fees. Matthew pays 2%. Taylor pays just 1%.
So only 1% or 2% difference in fees per year.
It's small, right? After 30 years, Taylor, with the 1% fee, has $761,000. Matthew, at 2%, has $574,000. Jason, paying 3%, he's left with only $324,000.
Good grief, Taylor has more than double Jason's money from the exact same investment growth, just lower fees.
That's the brutal math of compounding fees. It's like financial gravity pulling you down. So the insider move, the benchmark the big institutions shoot for. Keep your total annual costs, everything included, to 1.25% or less.
1.25%. But hang on, is that always realistic? What if you need, really specialized advice? Investing in some obscure emerging market or complex derivatives. Wouldn't you expect to pay more than 1.25% for that?
That's a fair question, and it hits on the narrative the high-fee guys push. Look, if you're doing something truly exotic, maybe. But for the vast majority of us, building a 401k, a brokerage account with core holdings, U.S. stocks, bonds, international indexes, anything much over 1% isn't paying for expertise, it's paying for marketing and overhead.
So for the foundational stuff, 1.25% is the absolute ceiling.
Absolutely. If you need super specialized advice later, pay a transparent flat fee for that advice to a fiduciary. Don't bake a high percentage fee into your core holdings forever.
Okay, fee trap busted. What's myth 3? Returns are not what they seem.
Ah, yes. The magic show of Wall Street math. This one hinges on a subtle but crucial difference between 2 ways of calculating returns.
Which are?
Time-weighted returns versus dollar-weighted returns.
Okay, bring that down.
When a fund manager boasts about a 20% return in their fancy brochure, they're almost always quoting the time-weighted return.
And that assumes?
It assumes you invested a lump sum on day 1, January 1st, and didn't touch it all year. It strips out the effect of when you actually put money in or took it out. It's designed to measure the manager's theoretical skill against a benchmark.
But that's not reality for most people, right? We contribute every paycheck to our 401k.
Exactly. What you actually experience, what hits your account balance, is the dollar-weighted return. This calculation reflects the timing of your actual cash flows, your contributions.
So how can they be different?
Think about behavior. Many people chase performance, right? They get excited after the market has already gone up and they pour money in them. Or they panic and sell after it drops.
Buying high and selling low, the classic mistake.
Precisely. If you do that, your dollar-weighted return, your actual return, will be significantly lower than the fund's advertised time-weighted return. Knowing the difference stops you from being fooled by marketing that ignores real-world investor behavior.
Got it. Now, myth 4 feels really fundamental, the broker conflict. I'm your broker, I'm here to help. People assume financial advisor means someone has to put their interests first.
That assumption is incredibly costly. There's a huge difference in legal standards. If your advisor is a broker or registered representative tied to a brokerage firm, they usually operate under a suitability standard,
Suitability, meaning?
meaning they just have to recommend products that are generally suitable for someone in your situation. They are not legally required to find you the absolute best, lowest cost option that puts your interests first. They're often incentivized, paid commissions, to sell the products that make their firm the most money.
So if their firm has its own expensive mutual funds, they push those, even if a cheap index fund would be better for me.
That's the conflict, plain and simple. And it leads to this lack of accountability, this lack of skin in the game.
Right, the study about fund managers not owning their own funds.
Yeah, that 2009 Morningstar study was shocking. Almost half, 49% of active fund managers owned 0 shares in the fund they were managing.
The chef won't eat his own cooking?
Pretty much. They collect their fee whether you win or lose. The solution: you must align yourself with a true fiduciary.
Specifically, an independent registered investment advisor, or RIA.
Yes. An RIA is legally and ethically bound to act solely in your best interest. That standard changes everything.
And the danger of not having that. We saw it in big blowups like Enron, didn't we?
Enron is a tragic example. By early 2001, it was clear the company was in deep trouble. Bleeding cash, red flags everywhere.
But the Wall Street recommendations.
Many major firms kept saying buy or hold almost right up until the bankruptcy. Why? Often because they wanted to keep Enron's lucrative investment banking business. Their advice was conflicted.
People lost everything holding onto that stock based on conflicted advice.
It shows how dangerous it is when the advisor's paycheck depends on something other than your success. As Upton Sinclair said, it is difficult to get a man to understand something when his salary depends on his not understanding it.
Okay, that leads nicely into myths 5 and 6 concerning 401ks and target date funds. The whole shift away from pensions.
That was a seismic shift. Pensions were defined benefit plans. The company guaranteed you an income in retirement. 401ks are defined contribution. You contribute, maybe the company matches. But all the risks, all the investment decisions, all the costs.
They fall on the employee.
Entirely. It was a massive transfer of risk and responsibility from corporations to individuals, often without the necessary tools or education being provided.
And the fees in 401ks can be high too.
They could be atrocious. The Department of Labor is trying to police it. But here's an insider tip for business owners listening. The liability for excessive fees in a 401k plan often falls on the business owner, the plan sponsor, not just the broker who sold you the plan.
Wow. Okay, good to know. And within the 401k, target date funds became the default, right? Especially after that 2006 law?
Yes, TDFs took over. They were marketed as this simple, set it and forget it solution.
Yeah.
Automatically get safer as you get older.
Sounds good in theory.
The problem is, they often create an illusion of safety. They're supposed to de-risk, but sometimes they don't de-risk enough or in the right way.
Like in 2008.
Exactly. In the 2008 crash, TDFs designed for people already in retirement still fell around 17%. And the ones for younger folks, the supposedly riskier ones, they crashed almost 40%.
40%. Why so bad if they're diversified?
Because the diversification was often superficial. They held stocks and bonds, sure. But in a real crisis, correlations spike, everything falls together. The bonds didn't provide the cushion people expected.
Why not?
Because the TDFs were often built based on dollar allocations, like 60% stocks, 40% bonds, instead of risk allocations. They didn't account for the fact that stocks are way more volatile. It wasn't true risk parity. Okay, so we've busted the myths, avoided the traps. Step 3 in the blueprint is about actually building the wealth machine. Strategic architecture.
Moving from vague hopes to a concrete plan starts with knowing your number.
Precisely. You have to calculate the price of your dreams. Get specific. What does financial security actually cost? Financial independence. True financial freedom. Clarity is power.
Because most people just have these huge fuzzy numbers in their head, $5 million, $10 million, and it feels impossible.
It paralyzes them. They block themselves mentally. You need to define it based on your actual desired lifestyle. We worked with a couple, Ron and Michelle.
Yeah.
They thought they needed maybe $20 million. Huge number. But when we sat down and calculated what their dream life actually cost their living expenses, travel, plus a big goal of giving $100,000 a year to their church, the real number was $10.2 million.
Still a lot, but half of what they were mentally blocked by.
Exactly. Suddenly it felt achievable. It became real. And that clarity leads directly to the core strategy, asset allocation.
This is the big one, right?
Yeah.
How you divide your money.
This is the key. Nobel winners, hedge fund gods, the biggest institutions, they all agree. Your asset allocation decision drives over 90% of your investment results. Way more important than picking stocks. It's about dividing your money into different buckets.
Okay, what are the insider buckets?
We use three main ones. Bucket number one, security, peace of mind.
This is the money you can't afford to lose.
Cannot lose. The goal is certainty, safety. Think basic human needs, what goes in here. Traditionally, U.S. Treasury bonds grade against deflation and TPS.
Treasury inflation-protected securities, remind us how those work again.
Sure. With TPS, the actual principal value of the bond adjusts up or down with inflation based on the CPI.
So if inflation jumps, the bond's face value increases.
Right. And the interest payments you get are a fixed percentage of that increasing principal. So your income keeps pace. When it matures, you get back the higher inflation-adjusted principal. It's built-in inflation insurance.
But safe stuff like treasuries often means really low returns, especially lately. Are there insider tools for this bucket that offer safety plus a bit more potential?
Yes, this is where it gets interesting. Two key tools. First, market-linked CDs.
CDs linked to the market, how does that work with safety?
They're issued by banks, so they're FDIC insured up to the limit. Your principal is 100% protected, but the interest they pay isn't fixed. It's linked to the performance of an index, like the S&P 500.
So you get market upside without market risk. How?
Banks use some of the potential interest to buy options on the index. It allows them to offer principal safety plus participation. Back in 2009, for instance, some of these offered average returns around 8% a year, with zero risk to the initial deposit. Perfect for the security bucket.
Okay, market-linked CDs, what's the second tool?
Fixed indexed annuities, or FIAs. Now, annuities get a bad rap, sometimes deservedly because of high fees or complexity, but used strategically in the security bucket, they are powerful.
How so?
They offer 100% principal protection guaranteed by the insurance company. They also give you upside participation in a market index, but usually with a cap.
Meaning, if the market is up 15%, but my cap is, say, 10%, I get 10%.
Exactly. You trade off that unlimited upside for the absolute downside protection. But the killer feature, the insider feature, is the locked-in gains.
Locked-in gains?
Yeah. Let's say the market goes up, and your FIA credits you with a 5% gain for the year. That new, higher value becomes your floor. If the market tanks 20% the next year, your account value doesn't drop below that floor you established the year before. It ratchets up, but never down.
Wow, so your gains become protected principal for the future. That's huge for peace of mind.
It's massive for stability in that security bucket.
Okay, security is locked down. Bucket number 2, risk growth. This is where we aim higher.
This is where we play to win, maximize long-term returns. Primarily, this means equity stocks. Despite the bumps, they are the best engine for growth over time.
Also real estate.
Real estate, absolutely. Either owning property directly or through REITs. And then for potentially higher growth, you might include some higher risk, what we call asymmetric return tools.
Like structured notes. Those sound complicated. How do they offer protection and higher upside?
They are a bit more complex, definitely for bucket 2. Think of them as a hybrid. They're usually issued as a bond from a major bank, so there's a debt component. But they also have a derivative, like an option linked to an index.
And that gives the asymmetry.
Exactly. You might get, say, 150% participation in the S&P 500's gains. So if the index is up 10%, you get 15%. But you might also have downside protection, maybe for the first 20% or 30% of a market drop.
So if the market falls 15% and I have 20% protection, I lose nothing.
Correct. But if it falls 25%, that 20% buffer absorbs the first part, and you'd only experience a 5% loss. You trade a bit of deep downside protection for potentially magnified upside. Requires careful selection, but powerful in the growth bucket.
And the final bucket, bucket 3, dream bucket. This is the fun money.
Yeah, this is maybe 5%, 10% max. This is for the stuff that keeps you emotionally engaged. Maybe some venture capital, crypto, if that's your thing, that passion project, like a piece of real estate you just love.
Like your Fiji resort example.
Exactly. Oprah's favorite spot, Nameli. It started as a bit of a wild dream investment, but ended up being valuable. The dream bucket keeps you from messing with the core security and growth buckets out of boredom or emotion.
Okay, buckets defined. Now, the cornerstone. Ray Dalio's all-seasons portfolio. He argues the standard 60-40 stock-bond mix is flawed. Why?
Deeply flawed, he'd say. Because 60-30 looks at dollar allocation, not risk allocation. Dalio's insight was that stocks are way more volatile than bonds, typically about 3 times more volatile.
So in a 60-40 portfolio, the stocks are actually driving most of the risk.
Hugely. That 60% in stocks might account for 85% or even 90% of the portfolio's total risk. So when stocks dive, the whole portfolio dives, even with 40% in bonds. The bonds just don't offer enough ballast.
So hoping the bonds will save you isn't a reliable strategy.
Not reliable enough. Dalio said you need to structure your wealth to perform reasonably well in any economic environment. He identified 4 key seasons.
Which are?
Rising growth, rising inflation, and falling inflation, or deflation. The goal is to build a portfolio where something is working well, no matter which season unexpectedly shows up.
And the key is allocating risk equally.
Yes. Allocating 25% of the portfolio's risk to assets that do well in each of those 4 seasons. That's the breakthrough.
So to get 25% risk in each, what do the actual dollar percentages look like? Because of the different volatilities.
They look very different from 60-40. A classic all-seasons allocation might be something like 30% stocks for growth, 40% long-term treasury bonds, strong in deflation, slow growth, 15% intermediate-term bonds, stability, some protection, 7.5% commodities for inflation, and 7.5% gold, crisis hedge, hyperinflation protection.
Wow, that's 55% in bonds and only 7.5% each in commodities and gold. Seems low for inflation protection.
It's about risk contribution. Those long bonds, while less volatile day-to-day than stocks, have a huge positive impact when things get really bad deflation or market panic. They provide the necessary balance. And commodities gold are very volatile, so you don't need huge dollar amounts to get your 25% risk allocation from them.
And the performance. How did this structure actually do?
The historical results are remarkable. Over a 40-year period, roughly 1974 to 2013, this all-seasons approach generated nearly 10% per year, 9.88% average annual return. And it only had significant losses in 4 of those 40 years.
Incredible consistency.
It protects you from market surprises, yes. But just as importantly, maybe more importantly, it protects you from yourself. It smooths the ride, makes it easier to stay invested, and stops you from making those emotional panic sells at the worst possible time.
Okay, the architecture is built. Now, how do we speed things up? Section 4, acceleration strategies. Strategy 1, save more. Seems obvious, but how?
Well, it starts with plugging the leaks, finding your latte factor.
The small daily wastes.
Exactly. David Back showed how even a $10 a day habit, coffee, lunch, whatever, if saved and invested instead, turns into over $141,000 over 20 years. Compounding works on savings too. Small leaks sink big ships.
But the really big wins are usually in the bigger expenses. Housing, debt.
Absolutely. For homeowners, the single biggest accelerator is often prepaying the mortgage. Just making one extra monthly payment per year on a 30-year mortgage.
What does that do?
It can cut the loan term almost in half. You can pay it off in maybe 16, 18 years instead of 30, saving hundreds of thousands in interest. That frees up massive cash flow much sooner.
Or a bigger move, literally.
Relocating. Strategic relocation can be like rocket fuel for savings. The cost differences are huge. Moving from, say, San Francisco to San Diego might save over 30% on housing alone. DC to Raleigh, North Carolina could easily boost your savings rate by 10, 20, even 30% overnight.
And there's that psychological trick. Save more tomorrow.
Yeah, that's clever. You commit today to automatically increase your savings percentage every time you get a raise or bonus in the future. You pre-commit the future money.
So you don't feel the pinch right now.
Exactly. Your lifestyle cost stays the same, but your savings rate climbs automatically over time. Painless saving.
Okay, strategy 2 for acceleration. Earn more, which means invest in yourself.
Fundamentally, yes. As the great Jim Rohn said, you get paid for bringing value to the marketplace. Your income reflects your value.
And this is more critical than ever now because of automation.
Hugely critical. We're facing massive disruption. Oxford research suggests almost half of U.S. jobs are at risk from automation in the next 20 years. Think about trucking 3.5 million drivers, potentially displaced by self-driving tech.
The skills landscape is shifting rapidly.
Under our feet. But Mike Rowe points out something important too. There's a massive skills gap right now.
Millions of jobs open.
About 3.5 million, he says, and the vast majority, maybe 90%, don't require a 4-year degree. They're in skilled trades, applied technology, healthcare, areas needing specific practical skills.
So retooling, learning new in-demand skills is key.
It's essential, whether it's a certification, trade school, specialized training. The people who thrive will be those who adapt and figure out how to add unique value in this changing world.
Strategy 3, tax efficiency. Using the tax code legally to keep more of what you earn and grow. Especially important if we think taxes might go up.
Which seems pretty likely given government debt levels. So yes, tax efficiency is crucial. The basics include using Roth accounts, Roth IRA, Roth 401k.
Pay the tax now, never pay tax on the growth or withdrawals in retirement.
Exactly. Tax-free growth forever is incredibly powerful, especially over decades. But for higher earners, there's a more advanced insider strategy.
The rich man's Roth, what is that?
It's called private placement life insurance, or PPLI.
Okay, life insurance as an investment wrapper sounds complex. Unpack that for us.
It is more complex, typically for accredited investors.
Yeah.
But it's a legitimate structure using IRS rules,
Yeah.
mainly Section 7702 for life insurance.
Yeah.
Essentially, you place investments, hedge funds, private equity, whatever, inside a specially designed life insurance policy.
And the benefit.
Those investments grow tax-deferred. And structured correctly, the money can eventually be accessed, often through policy loans, completely tax-free. It mimics a Roth, but potentially with much higher contribution limits and investment flexibility.
So it turns taxable investment growth into tax-free growth. What's the difference in real dollars?
It's staggering. Take a $1 million investment, compound over 40 years, if taxed each year along the way, maybe grows to $7 million. Put that same $1 million with the same growth rate inside a PPLI structure. Because you avoid the annual tax drag, it could grow to over $30 million.
Wow. 4 times more money just from the tax efficiency.
Same investment, same time frame, profoundly different outcome. It's a powerful tool the ultra-wealthy have used for years, leveraging the tax code legally.
Okay, that brings us to the really long view. Technology itself as a kind of hidden asset.
Yeah, this is Ray Kurzweil's territory, head of engineering at Google. We're in an era of exponential technological growth.
3D printing organs, nanotech, AI.
Life extension science, new energy sources. It's accelerating incredibly fast. Kurzweil's point is profound. Your goal should be to live long enough for the technology to catch up.
Meaning
Every year you stay healthy and financially secure increases the odds that breakthrough technologies will arrive to further extend your healthy lifespan, letting you enjoy the rewards of your disciplined investing even longer. Health and wealth become synergistic.
Which leads perfectly to the final secret, doesn't it? Beyond the money itself. Fulfillment. What did these masters say about true wealth?
They all circle back to the same thing. The ultimate wealth isn't just the number in the account, it's the ability to fully experience life. And the single greatest thing money can buy, the thing that brings the most lasting happiness,
Is giving it away.
investing in others. Giving it away. The research is overwhelming on this. People consistently report higher levels of well-being, more happiness, even better physical health when they spend money on other people versus on themselves.
Even small amounts matter.
Absolutely. It's the act of contribution. It creates this virtuous cycle, too. The better you become at building the financial machine, the more resources you have, the more you can give. Think of things like swipe out hunger, using tiny bits of change to provide millions of meals. Giving feeds the soul. It ensures wealth serves a purpose beyond just piling up.
So wrapping this all up, what's the core message? Financial success isn't really about luck or finding the next hot stock.
No, it's about mastering two things. The strategy asset allocation, controlling those darn fees, being smart about taxes,
Right.
and maybe even more critical.
Mastering your own psychology, your story, your behavior.
Exactly. You have to take control of the architecture, fight those hidden costs, challenge your limiting beliefs. But, and this is crucial, don't get so lost in building the machine that you forget to live.
The masters emphasize gratitude, right?
Above all else, gratitude over accumulation.
Sir John Templeton had that amazing quote.
He did. If you've got $1 billion and you're ungrateful, you're a poor man. If you have very little but you're grateful for what you have, you're truly rich.
So the final question for you, listening, isn't just about how much you can accumulate tomorrow. It's about what you choose to appreciate today. Financial freedom, in a way, starts the moment you decide to start rich. Rich in gratitude. Make that decision now.